We'll start with the venture capital method. It was developed by Harvard Business School professor Bill Salmon. As its name might imply, it's often used by venture capital professionals or VCs. It's primarily used to value early-stage companies, usually in the absence of historical revenue and earnings. It's based on the premise that if we know the value of something in the future, and we know what kind of return on investment is needed to induce an investor to invest, then we can figure out the company's present value. Present value, or PV, equals current, pre-money, or pre-investment valuation. The venture capital method incorporates some elements of discounted cash flow methods, insomuch that one must apply a risk premium, expressed as a return or discount rate, and it makes some assumptions related to future performance to determine present value. But it is based on future terminal or exit value rather than cash flows. Before we go any deeper into the venture capital method, there are some key terms to understand. Pre-money valuation, the valuation of the company just before closing a new round of investment, including the value of the idea, the intellectual property, the assembled management team, and the opportunity. Post-money valuation, the valuation of the company immediately after a round of investment is closed. Terminal value, the valuation of the company at exit. That is, the proceeds of the sale of the company via a merger or acquisition or an initial public offering, and at which time the investors and other shareholder ownership can be liquidated. Return on investment, or ROI, the cash-on-cash return on investment expected for such an investment in the year of the harvest or exit. ROI is commonly expressed as a multiple of invested cash, for example, 10 times or 10x, regardless of the time since investment. So how does this method work? Like many mathematical formulas, we can look at the exercise from different angles. We can use the related formula to calculate exit value, post-money valuation, percentage ownership, and of course, pre-money value. Let's dive into a case study for a better understanding of how this works. In the following case study, a VC is considering investment in 3 different companies, but she is unwilling to invest unless she can obtain a return on investment, or ROI, of 30% from her proposed $1 million investment. So let's say you're company A. You're building a company and expect to be making $15 million in net income when you sell the company in 5 years. First, we need to multiply this value by a price-earnings ratio, which should be selected based upon benchmarks for similar public companies. For the purposes of this exercise, let's choose a price-earnings ratio of 6 times. $15 million times 6 equals terminal value of $90 million. Then, we divide this number by our anticipated ROI to get the post-money valuation. Let's use the investor's target of 30x for this example. We divide the terminal value by this anticipated ROI to get the post-money valuation. $90 million divided by 30 equals $3 million post-money valuation. Finally, we need to subtract the investment amount from this post-money valuation to calculate the pre-money valuation. $3 million minus $1 million equals a $2 million pre-money valuation. As you can see, the venture capital method may produce a more optimistic pre-money valuation than other methods. It's based upon future projections, which may or may not be accurate and realistic. The Berkes scorecard methods, which we will discuss a little bit later, focus more on the current state of affairs. For downloadable spreadsheets to help with calculations using the VC method, please see the links we've provided with this video. Activity: download the VC method spreadsheet and play around with some of the input fields to get a better understanding of the relationship between pre-money, post-money, terminal or exit value, and ROI, and the associated calculations. In thinking about your own company and fundraising goals, ask yourself several questions related to valuation. Number 1, does your expected exit timeline align with that investor's desire? 2, Can you validate the growth rates and comparable forecast terminal or exit value for investors? 3. Can the forecasted exit value provide an investor with the target return they would need to make an investment? 4. Given the ROI investors need and the portion of equity they would demand to achieve that return, is there sufficient equity left to motivate you, as a founder, to invest the next 5 to 7 years to scale the company and facilitate an liquidity event for the benefit of shareholders? If you're an investor and you could invest in company A, B, or C, which would you choose and why? Assuming no additional investment, which company produces the greatest return for the venture investor?